You have an advanced degree. You run a successful business. You manage complex systems every single day with precision. Your income reflects that excellence. Yet, there's a nagging feeling that your wealth isn't growing with the same level of sophistication. That's because one critical machine in your life is broken. The fundamental error is that we treat our finances as a hobby. We read an article, buy a stock, we hear a tip, we chase a trend. These are disconnected tactics, not a system. It's like trying to build a skyscraper by randomly stacking bricks with no blueprint. It's doomed to be inefficient. Your high income is a powerful engine, but right now it's bolted to a chassis with flat tires and no steering wheel. The power is being generated, but it's not being translated into forward momentum. The result is financial drag, inefficiency, and immense opportunity cost. This isn't about working harder or earning more. You've already solved that problem. This is about building a transmission system that effectively converts your professional success into durable generational wealth. It's about aligning the gears so that every dollar you earn works as intelligently and tirelessly as you do. The solution isn't another hot stock pick or a complex derivative strategy. The solution is to step back and become the chief financial officer of your own life. You need to create the governing philosophy, the master plan, that dictates every financial decision you make from now on. Every successful corporation has a mission statement and a strategic plan. We're going to build one for your money. It's a simple, one-page document that will provide more clarity than 1,000 hours of financial news. And it starts with defining your personal economic blueprint. Welcome to the Personal CFO Mindset. Your first and most important task is to create an investment policy statement. This is the secret weapon of institutional investors and the ultra-wealthy, yet almost no individual investors use one. This document is your constitution for building wealth. It removes emotion and prevents costly mistakes. Your statement has 3 core components. First, your objectives. Be specific. Is this for retirement in 20 years? A major purchase in 5? Are you aiming for capital preservation or aggressive growth? Quantify it. For example, achieve a 7% real annual return over a 15-year horizon. Second, your constraints. This is about defining the rules of the game. What are your liquidity needs? What is your true time horizon? What are your tax considerations? Are there any specific assets you will explicitly avoid? This sets the boundaries that keep you safe during market chaos. Third, and most critically, your monitoring process. How and when will you review your portfolio? Not daily, not weekly. You will define a disciplined, systematic review cycle, perhaps quarterly or semi-annually. This prevents panicked selling during a downturn or euphoric buying during a bubble. You follow the system, not the headlines. Writing this document forces you to move from vague hopes to concrete strategy. It transforms you from a passenger in your financial life to the pilot. Every future decision is now filtered through this simple question: does this align with my policy statement? If the answer is no, you don't do it. Now that you have the Constitution, it's time to build the engine it governs. This is your strategic asset allocation. It's the single most important determinant of your long-term returns, and we are going to approach it like a world-class engineer builds a machine. Forget what's the best stock to buy, KISS. The right question is, what is the optimal mix of assets to achieve my objectives within my constraints? KISS. This is asset allocation. It's not about picking winners. It's about building an all-weather portfolio that performs reliably across different economic seasons: inflation, deflation, growth, and recession. Think of your portfolio in terms of jobs to be done. You need a component for growth, typically equities. You need a component for stability and income, typically bonds. And you need a component for inflation protection, like real estate or commodities. Each asset class has a specific role to play in the machine. Your percentages are determined by your policy statement. A young professional with a high risk tolerance might have an 80% allocation to growth assets. Someone nearing retirement might have a 60% allocation to stability assets. There is no single right answer, only the answer that is right for your specific, documented goals. Inside each bucket, diversify relentlessly. Your growth bucket shouldn't just be U.S. tech stocks. It should include international equities, emerging markets, and small-cap stocks. This diversification is your primary defense against the failure of any single component. It's the ultimate form of risk management at the system level. The beauty of this approach is its simplicity. You're not day trading. You are the architect and manager of a system. You choose low-cost, broadly diversified index funds, or ETFs, to fill your allocation buckets. You set the percentages, and you let the market do the heavy lifting for you over the long term. With your engine designed and built, most people think the job is done, but they're wrong. A powerful system without robust safety protocols is a catastrophe waiting to happen. Next, we build the risk shield that protects your entire financial life from the one thing that can destroy it: you. The greatest risk to your portfolio isn't a market crash. It's your own behavior during a market crash. The risk shield is a set of pre-committed rules designed to protect you from your own worst emotional impulses. The first rule is the rebalancing protocol. This is the only market timing you will ever need. Your policy statement dictates your target allocation, for example, 70% stocks and 30% bonds. After a bull market, your portfolio might drift to 80% stocks. Rebalancing means you systematically sell some stocks to get back to 70%. This forces you to sell high. It's a non-emotional, system-driven action. Conversely, after a market crash, your portfolio might be 60% stocks. Your rebalancing protocol forces you to sell bonds and buy stocks to get back to your 70% target. This makes you systematically buy low when everyone else is panicking. It's a difficult but incredibly powerful wealth-building mechanism. The second rule is the liquidity protocol. You must have an emergency fund of 3 to 6 months of living expenses in cash or cash equivalents, completely separate from your investment portfolio. This is your firewall. It ensures you never have to sell your long-term assets at the worst possible time to cover a short-term emergency. Finally, the debt protocol. High-interest debt, like credit card debt, is a guaranteed negative return that will destroy your portfolio's performance. Your policy statement must include a clear rule to eliminate and avoid this type of debt before any aggressive investing. It's plugging the biggest leak in your financial boat. You now have the blueprint, the engine, and the safety features. The final step is to put this entire machine on autopilot. We will now install the automation flywheel that makes this system run efficiently in the background of your life, requiring minimal intervention, which is the ultimate goal for a busy professional. The goal of a perfect system is to produce the desired outcome with the least amount of ongoing effort. For your wealth, this is achieved through automation. The first step is to automate your savings. Set up an automatic transfer from your checking account to your brokerage account every single payday. Pay yourself first, always. Second, automate your investments. Most brokerage platforms allow you to set up automatic purchases of your chosen index funds or ETFs. That money that was just transferred, have it automatically invested according to your target asset allocation. This is dollar cost averaging on autopilot. You are consistently buying, regardless of market noise. You can even automate your rebalancing. Some platforms and robo-advisors offer automatic rebalancing when your portfolio drifts beyond a certain threshold. This removes even the temptation to tinker. The system executes the strategy for you, unemotionally and efficiently. This is the epitome of working smarter, not harder. Your only job now is your scheduled review, as defined in your policy statement. Once a quarter or twice a year, you spend 1 hour, not to check performance, but to check if your life circumstances have changed. Did you get a major promotion? Did your goals change? If so, you adjust the policy statement. If not, you close the laptop. This is the final result. Your income gear is now perfectly meshed with your wealth machine. It is guided by a clear constitution, powered by a diversified engine, protected by a robust risk shield, and runs on a flywheel of automation. It operates in the background, compounding silently, freeing up your most valuable asset, your time and mental energy, to focus on what you do best. You've moved from being a gambler to being an architect, from a speculator to a system operator. This is how you translate a high income into true, durable wealth. This is how you fix the machine. Take these principles, write your policy statement today, and start building your financial flywheel.